All right, let's talk about one of the most powerful and honestly most misunderstood strategies in all of finance, the covered call. Now, this isn't about some high-risk gamble. Far from it. This is about generating real, consistent income from the stocks you already own. And today, we're going to break down exactly how it works, step by step. But first, before we get into the nuts and bolts, I want to show you a number. And frankly, it's a pretty shocking one. According to the Chicago Board Options Exchange, a whopping 73% of retail options traders lose money. I mean, think about that. That is just a staggering failure rate. So you gotta ask, right? In a market that's just flooded with people swinging for the fences, trying to hit a home run, why is one of the most reliable and conservative strategies so often just left on the bench? Well, that's the paradox we're gonna unpack today. And this brings us to what I call the trader's paradox. You have this massive $4 trillion a month options market. It's huge. And yet, the vast majority of individuals who participate in it are consistently losing. How does that make any sense? Well, here's the thing you really need to get. The problem isn't that options are too complex. They're not. The problem is that most people treat them like lottery tickets. They're just chasing these massive, life-changing gains instead of focusing on strategies that actually have a statistical edge. And the covered call? It's the exact opposite of that lottery ticket. So what's the solution here? Well, it's a strategy that lets you, in a way, rent out the stocks you already own. I want you to think about it just like that. You're turning your portfolio into a cash-flowing asset, basically an income machine. So here it is, the official definition. A covered call is actually a really simple trade. You only need two things. First, you've got to own at least 100 shares of a stock. And second, you sell someone the right, not the obligation, but the right to buy those shares from you at a specific price by a specific date. And just for selling them that right, you get paid cash right away. We call that the premium. Let's just walk through the mechanics real quick. You'll see just how simple this is. Okay, step 1, you own 100 shares of, say, Microsoft. Step 2, you sell one call option contract against those shares. You're just agreeing to sell them at a price that's higher than what they're at now. We call that the strike price. And then step 3, you immediately get cash deposited right into your account. That's it. The trade is done. And here's the beautiful part. This trade can only end in one of two ways. Outcome 1, if Microsoft stock stays below that price you agreed on, the option just expires worthless. You keep your 100 shares, and you keep the cash you were paid. Outcome 2, if the stock goes above that price, you just sell your shares at that higher pre-agreed price, and you still keep the cash premium. See? In either scenario, the premium is yours to keep no matter what. So, like I said, actually executing the trade, that's the easy part. But the real skill, the art of it all, really just comes down to two key decisions that you have to make before you even click the button. And this right here is the fundamental trade-off. It's a choice you have to make every single time. What's more important to you right now? Do you want to collect the most income possible today? Or do you want to give your stock a little more room to run up in value? Because you can't have both. And that choice all comes down to the strike price you pick. See, if you sell a call with a strike price that's really close to the current stock price, we call that at the money, you're going to get a nice fat premium, a big paycheck. But you're capping your potential for growth almost immediately. On the other hand, if you pick a strike price that's further away, out of the money, you'll collect less cash up front, but you give the stock a lot more room to appreciate before you'd ever have to sell it. Now, the second key decision is all about time. See, options are like a melting ice cube. They lose value every single day as they get closer to expiration. We call this time decay. And as an option seller, time decay is your absolute best friend. All the data shows that the strategic sweet spot is selling options with about 30 to 45 days left until they expire. That's where you get the most bang for your buck from that melting ice cube effect. Okay, so that's all the theory, but how does this thing actually hold up in the real world, over the long haul? Well, let's take a look at what decades of data tell us. The very first thing that jumps out from the CBOE's own data is that this strategy gives you a much smoother ride. Over almost 25 years, a systematic covered call strategy was 24% less volatile than just buying and holding the S&P 500. It dramatically cuts down on those big, scary swings in your portfolio. Now, you're probably thinking, okay, lower risk, that must mean way lower returns, right? Well, here's the incredible part. That's not really the case at all. The covered call strategy returned 9.2% a year, while the S&P 500 did 10.4%. You give up just a tiny sliver of return, but in exchange, you got a massive reduction in risk. I mean, for most investors, that is an absolutely phenomenal trade-off. And here's why that trade-off works so well. In a flat, sideways market, the income you're generating from those premiums means you actually outperform just holding the stock. In a bear market, that same income acts like a cushion, seriously reducing your losses. The only time this strategy underperforms is in a rip-roaring bull market, because your gains are capped. See, this strategy is built for consistency, not for hitting moonshots. And that brings us to the final, and you know what? Maybe the most important point of this whole thing. The biggest challenge in actually running this strategy successfully, it isn't about the numbers or the charts. It's all in your head. The number one reason people give up on this strategy is a psychological trap called regret aversion. It's that awful feeling in the pit of your stomach when you have to sell your shares at your agreed price, but then the stock just keeps screaming higher. You see all those gains you missed out on, and it just feels like you failed. You have to reframe your thinking on this. You have to. When your shares get sold or called away, it is not a loss. It is the successful execution of your trade. You went in with a plan to make a specific maximum profit in a specific amount of time, and you did it. You achieved your goal. That, my friends, is a win. And so that really leaves us with one final question for you to think about for your own investing. Are you looking for the discipline of a strategy that's built to generate consistent, predictable income over time? Or are you just chasing the thrill of a lottery ticket? Your answer to that question will tell you everything you need to know.